All right, welcome to Mind Over Matter, Market Mastermind. This is Cedar. We're going to go back to doing these weekly because I think they're such an important part of what the trading experience is to be able to look at how you're thinking about trading, what you're struggling with. So, Mind Over Matter, the psychology of trading. And I may have to move it day by day, but if I can get a recording out for you guys, I'm hoping this helps. So, I'm going to start with something I was talking about this morning pre market. And I posted this back in 2021, but I don't mind repeating things from trading psychology because they're so relevant ongoing for everyone, including me. So, goal of buying the dip is to buy things low that traders will want to own later at higher prices. The thing I ask myself before a trade are one, what's the market structure, range or trend? That's what we talk about in looking at the analysis as far as higher time frames when we're looking at what we do in the group coaching. So market structure, when I was talking yesterday about the fact that we had the 50 daily moving average and the 10 weekly moving average basically in the same range, that kind of structure is what's more important to me than some wicks or some candle bodies, the actual volume and where those moving averages are, because that's what the majority of the market participants, aka the people who move the market, or what they're looking at. So major support and resistance, and there's a difference between support and resistance and supply and demand. Support and resistance are based off of those candles. Supply and demand, the candles can be involved, but the volume is what really matters as far as how price is interacting at those volume levels. So watching that first group coaching session that I recorded last week, which is similar to the First New Traders Bootcamp, just shortened form and covering just VRVP, Visible Range Volume Profile, I think will be a very helpful session for you to listen to or to watch, to participate in. So you need to have those identified on your chart. You need to be aware of them. I round anything on ES. I shouldn't say anything. I round most levels on ES to numbers that end in fives and zeros because that is something that ES loves. Same thing that you have with NQ, ending in zero, double zeros, especially triple zeros for sure. And it's a psychological thing. So not the real numbers, but if they're close enough, I go ahead and round them out. So what's more important is what I was talking about this morning is, can I lean my stops against support and resistance? Where would my stops be? Where would my TPs be? So where am I going to take profit on this position? If I take it, it can be the most beautiful entry ever. However, if you're $2 away from where the next glaringly obvious take profit is for shorts, that's late to the game short and harder to stay in. So that is weaker hands short positioning. And so that's why waiting for those key structure levels for me is so important. So next one, where would the opposing pressure come in? So those opposite the trade that I'm in. So if I'm short, where are the longs looking to buy? If I'm long, the shorts looking to sell, because it's not just about what's on the chart, but what other people are looking, other participants are looking at on the chart in relation to how they're going to execute, because I'm nowhere near a large trader that's going to move the market. And that's what's great about it is we're looking at obvious levels. We're looking at things that seem minuscule as far as we look on the chart, but when you've got key structure areas like a 50 daily moving average, opposing pressure will come in at the 50 daily moving average. And we're actually seeing that right now on the charts. We've got equal highs in the RTH session as look above and fail so far, at least of the 50 daily moving average and the weekly 10, and something we've been talking about for a couple of days. So paying attention to what other participants are looking at, not just what you see on the chart, but who's opposite that trade from you Where will they come in? What's that participation going to look like? Because that can influence what's going to happen to your trade, even if it looks like the perfect long. If the shorts are going to come in and start trying to short it there heavily, you might have yourself too small of a trade to make it worthwhile. So then number 5, and I'm going to reply to this original post in the psychology channel with this video, just so you can have that. Number 5, how is price moving? Is it choppy or is it clean? And we have seen choppy, whippy, absurd price action for summertime trading. We've seen big ranges. I think yesterday, SPY had the 4th lowest volume of the year, which is not unusual for summer, but we moved over 2% to the downside. That's unusual for summer, any summer, low volume. So just because it was doesn't mean it is. And that's one of my favorite sayings. You guys that have been around for a long time have heard me say, it never is what it never was. So next one is volatility expanding or decreasing? And the term I use a lot recently is expanding and contracting, but decreasing is what's in the post. So I'm going to use that. So decreasing volatility are the days when we see smaller and smaller ranges. Increasing volatility is why we watch the VIX to see, like right now we're on the lows on VIX, and here we are at new highs on the day, above 5505 key level. Some of the things that are often helpful for us are challenging in other environments. So just because, like, I changed from using UVXY, which is a 1.5 leverage ETF of the VIX, because it stopped helping me as much as VIX was to see from a responsiveness perspective what's happening as far as the call to put ratio. And that's what the volatility measures, is call to put ratio. So if we see new highs on the day and moderate lows on VIX, we know that puts are being sold, which makes sense when you see new highs on the day, but we're not seeing acceleration. They're not moving together, which they do sometimes. So it's important to remember that VIX is not an inverse. If you're looking for an inverse, you go to something like a triple leveraged QQQ, SQQQ versus NQ or QQQ. But they're just inverse. They're straight inverse. Where VIX, the volatility measure, and we have a post from PKP in the Word of the Day channel that goes more into depth about it, but it's essentially a measurement of call to put ratios that is important to be aware of. So when we have them moving the same direction, so volatility is expanding, so VIX is running up, and SPX, SPY, ES, whichever you're following, is also running up, we know that one of them is probably lying, because that means there's more puts and we're moving up into price. So one of them will probably break. Right now, while we're continuing to see lows on the day on VIX and new highs on the day, it's doing what it's supposed to do. So paying attention to these indicators, which for me, VIX is an indicator, even though it's not something to add to the chart. It's why I started to include it in my 30-minute execution chart, because it gives a snapshot of what I have visible on my cross section of screens, which you guys get to see one of the screens that I have 2 other things on besides when I'm streaming, but I chose to make that stream be my 30-minute execution chart with all crazy data, my crazy chart, along with the 5-minute 10 MA in the bottom right-hand corner, along with the ADR and the 200 moving average, the VIX in the bottom center, and then the 4-hour also with the ADR, which coincidentally, I'll just go nudge, nudge, wink, wink. We're at the bottom of the ADR top end range right now at previous value area high. So paying attention to what the key structures are, even though it's not your psychology, it's knowing where we are in relation to where other traders are interacting opposite of you on the trade. And that's the biggest thing. Opposite of you on the trade, if you're long, what are the short traders looking at? If you're short, what are the long traders looking at? Where will they enter? Where do new money participants come in? Where do existing positions exit? Is going to be a really important part of your journaling process. So I'm actually in the process of putting together a one trade, one page journal that will include these questions, some psychology questions that I think will be really helpful for those of you struggling with psychology and making objective trade decisions instead of just jumping in like, oh, I feel like we should go long. Well, why? What's the thought process behind it? What's the key structure behind it? Where are you mentally? Are you struggling with something that's a personal thing outside of trading that could potentially be clouding your judgment? That kind of thing that I think is probably one of the most important pieces to pay attention to. So I do have one more that I wanted to talk about before I dig into the questions. Oh, I'll actually do that after the questions. Okay. So this is a DM straight from one of our members. It says, sometimes when I'm in a trade along with you, my TP would be a certain resistance or support level, but you tend to hold sometimes and it ends up blowing past that level for more gains. What makes you hold? Why do you use levels as TP? Or is it mainly price action? I guess the same. When a trade is red, I get out sometimes, but then you would hold and it does a complete swap. So the answer to both of those is supply and demand, the VRVP. It's the look left scenario, understanding where other traders have been trading. So I really love this question because it's super relevant to what I'd planned on talking about with the what are the participants opposite of you doing. I want to see the tempo. I want to see how price is moving in relation to a level, which is where I don't have hard stops most of the time. Now, we have seen me do some more moving stops to break even recently because of how whippy price action has been. And I'll just do a little reminder of you don't want to be chasing alerts anywhere. I don't care where you're trading. You want to use limit fills, for me especially, because at least half of the time, placing a limit order, I'm selecting positions for my alerts that are very likely that members are able to get in on at my entry price or a better entry price. If prices moved quickly, and we saw this yesterday, I think, by the time I unmuted, it was $3. $3 in profit. You don't chase that kind of increase. I mean, it was less than a second, maybe a second worth of time to unmute, didn't even have time to type it. It's really important that you're using limit orders. If the trade is missed, what you want to do is use that as a learning opportunity as far as the next time you see that setup, the next time this presents, and carry that forward. And trading is a collection of over and over and over again, you're seeing these same setups. You start to build a profile of when I'm above the overnight high and above the 50 daily moving average. When I'm seeing previous value area high overhead as resistance and previous week low, AKA what's happening right now, am I likely to see continuation above the levels that we're trading at? And that takes time. It's not something that I can just say, here's the answer. It takes trading time. I call it road time, driving time. You have to have watched it. You have to have understand what the tempo looks like in that kind of scenario. We should see selling right here. Now, looking at how many 5 green 30-minute candles, should see continuation if you're just looking at pure chart structure, but because of the key structure levels of previous value area high and previous week low overhead, the context is what's most important. So looking at the context, paying attention to that is how I make those decisions. It's where I am likely to see rejection in the position. And that's why I don't use just a strict $2, $5, $3, whatever stop, because sometimes it's an entry based on where we are in the chart, but I'm comfortable with, because of the volatility, it moving into those ranges below as long as it finds support. And the flip side is when you're counter trend trading, and maybe that's one of the best things to talk about, is the difference between trading with a trend and counter trend trading. Counter trend is hit and run. You sell into whatever strength is there. So if we're in something like right now and you're thinking, all right, here's previous value area high, I'm going to go short, you don't get married to that position because it's counter trend to what's happened for the last 2.5 hours on our 30-minute candles, selling into strength. See green, take green, as you've heard me say for years, versus more room when you're moving with the trend to be able to go back and look and see who we left behind is really what happens. So next one, question wise. All right. So somebody who is red over 2 years is not unusual. And it's very frustrating when you're in the middle of it. I lost my trades. Overall, for the first 2 years, I was a losing trader. And it was a significant amount of money. It was insurance money, so, it didn't break the bank literally. There's our one tick shy rejection of previous week low on ES. So for me, it didn't change what was happening day to day from the perspective of losing the money, but it was enough money that it would have made the difference for my family that I probably would not have done the things trading that I do now because I had to make it back after losing it, if that makes sense. So that loss actually turned me into the trader that I am right now. And I shouldn't say that loss, those losses over 2 years, because they took me to a point where I had to say, this, I lost it this way. This is the only way I'm going to make that much money back, which proved to be true once I started paying attention to trading psychology and position sizing, which is why I chose to go ahead and open my own Discord. And I really did struggle with that when we had all the chaos and drama of the old server closing without any notice and all kinds of people paid and didn't get refunds and staff not paid. I really had to ask myself, do I really even still want to be involved in anything like that? Why were you there in the first place? And the answer is, I was there in the first place to help newer traders in a way that I could not find help myself from a give back to the community perspective. So that's why I did decide to move forward with opening this Discord, was because that was why I put myself in that situation to begin with, not because of the server owner, never knew him in person, never had interactions other than what was inside the server. It always goes back to me for what did I need help with, and can I help members also have that I was looking for. So you're not going to be massively profitable at the beginning. So all the promises of 1,000% gains and all of the Lambo and Rolex pictures, in fact, whenever I see somebody posting pictures of a Rolex, I know 100% that person's about to blow their account or already did, and they're trying to like save face or regain whatever psychology they needed to. The more somebody has to brag about how much money they have and how great they are, the less likely they are to be around, or less likely they are to be actually authentically doing what they're representing to be doing. It's really important that you're focused on the production of your trades, the execution of your trades, how well over 100 trade data set you're performing. It's way less important about social media and about bragging rights. And I post my stats because that's what people look for. That's what the population is conditioned for as far as, looking at social media. It's the gains. And I'm about transparency. I'm about, here's what I'm trading. Would you like to see how that works? Would you like to see the levels that I'm looking at, and that's why I stream the charts. That's why I, try to talk about levels and talk about the trading psychology as much as possible through the day and through the week. But the key is always going to come back to you. And when you tie money in from a psychology perspective, as soon as you tie money into decision making, emotions become a massive factor. So we are not robots. We're not going to be able to stop feeling emotion and act robotically. We have to disregard the emotions for decision-making process. So not let the emotions trade our accounts, but actually make the decisions based off supply and demand, based off of volume. And my indicators are all volume based because the volume is king. And those of you guys that have been around for a long time have heard me say that all the time. Volume is king. What's happening in price action? Where are the traders trading? What are the participants who are moving the market doing? I'm going to use what they're doing to take my little piece of the pie. So I'm reading a follow-up to a DM. Give me just a second. Okay, yeah, the follow-up for that is a lot of what we talk about. So FOMO from exiting a trade prior that ended up moving in your direction. And so then allowing that to affect the next trade. It's really important that you do not allow any previous trades to make decisions for you in current trades. So once you flip that page, that's why I like the 1 page per trade kind of reflection. Is it's not a collective of the day. It's you're only as good as your last trade. If you chose to exit something at a loss and it ended up going in your direction and ended up gain, the best thing to do is to go to your journaling and do market replays, re-look at the position and ask yourself, is there anything I missed? So from a FOMO perspective, I do not go back and go, damn, I wish I would have held that. I will say, man, I missed that there was Secretary Yellen speaking. I missed something that would have helped me make a better decision in the trade. Do not focus on the amount of money lost, or more importantly, the amount of money that could have been made had you stayed in. Because what that does is the next time you're in a position, it clouds the judgment and makes it where you might stay in a trade that you shouldn't be because of the last trade. So that is a form of FOMO for sure. And then follow-up question to that was the right number of contracts for prop accounts. So you have to think about prop accounts like the trailing drawdown. So my 25K personal account is 25,000 in personal funds. It is not a 25K prop account. A 25K prop account is like $2,000 in trailing draw, 1,500 trailing drawdown. It's very small. You should be trading 1 MES, maximum 2 on prop account with that amount of drawdown. So really important that if you are blowing accounts, if you're struggling with that, go in and watch my New Trader Bootcamp number 9 on prop accounts about proper sizing. I think it will make a big difference because there is a difference between having that trailing drawdown. Now, once you get past it, you can use those larger contract sizes because you've built a bigger buffer. But when you're passing a combine or passing an evaluation and getting through your initial funding experience, you have to make sure you're trading it small because you're not trading 25,000 on a 25K PA. You're trading 1,500. And there's a really different approach to that. If I put 1,500 in a funded account, a personal account that I fund, I would definitely not be trading more than 2 MES contracts on it, period. So that information is actually in the New Traders Bootcamp number 9. It's the most recent one that I filmed prior to our transition to this new server. So that would be my recommendation as far as that goes. And I have one more DM question. Oh, this is hysterical. Can you help me not be bearish? So there's a little bit of an addictive piece to being bearish because it's fast. that counter trend, it's me taking longs at key structure and seeing the move happen in 5, 6, 7, 10 minutes, where I typically like to see 30-minute, I like to see intraday swings, 30-minute plus. At 10 minutes, I'm like, oh, really? We couldn't wait for a little bit? And I know that it is the addictive piece to that faster money, because when you're in a bull market, and we've been in a bull market with the exception of 2022 for the better part of a decade and a half. So it becomes like squeeze the morphine button. Ooh, give me some more, which is totally fine. It's the adaptability, it's the switches between the two. So the bear addiction comes back to fast money, at least in my eyes. And I don't trade. I mean, I have been trading short some, but I don't trade short a lot because it's just not my thing. I guess that's the best way to put it. And some of it is because I like relaxed, ride the waves up kind of trading. And I think that's why a lot of members like to trade with me, is because I'm interested in the direction of the trend. But when you miss the direction of the trend, it's okay to be a bear, to take those faster shorts. So that the shifting gears, I mean, it's the difference between driving a manual transmission vehicle. You don't want to be driving in second gear on the freeway. And I think that's what a lot of the bears have gotten over the last year or so. Short everything. They're driving at 60 in second. Gears running high and hot, and transmission is overloaded. You got to the right speed, but not in the right gear. So my suggestion, if you're having a problem with losing because you've got that bearish kind of mentality, is to not counter trend trade. And stopping something that's addictive like that is a pretty challenging thing, and it's going to go back to journaling. So if you can answer the question of, is this a counter trend trade, and you can check the box, then you don't take it. I think it will help directionally make it where you're more looking for in an up market, you're buy the dip; in a down market, you're short the pop. And that's not to say that you shouldn't be trading both directions. It's just, if you're finding yourself overly bearish and have gotten crushed this last, we can even just say since 2024, since the start of it, which I see so many people. So that's one of the reasons I recommend it, to be careful as far as what you're looking at on social media, because the macro, what the economy is doing says we should not be doing what we're doing in the market, but Main Street is different than Wall Street. And keeping that in mind, I think, is one of the biggest pieces. I am running a little bit over on time right now, but I am going to give you a challenge. For the next 30 days, I want commitment and deliberate action for a couple of things. You're going to focus on one defined system, what your edge is. If you don't know what your edge is, you have to do that first. You have to find out what your trading edge is. So that can be, and I think the easiest is, look below and fail, or look above and fail. So LBF, LAF. Focus on thinking in probabilities, not thinking on your P&L. So focus on probabilities. Over 100 trades, 65 of them are going to be correct. If you're not oversizing, knowing what your metrics are, you're going to be overall profitable. So you have to track it. You have to know what your metrics are, but focus on the probabilities, focus on volume and pure price action. So if you have 5 oscillators and then RSI and then clouds everywhere, and that's not to say my 30-minute execution chart is crazy, but it's based off of volume levels and the previous 2 days trading range and the previous week's trading range. So while it does look crazy, I know what to do with it, and it's my defined edge. You're going to have to define your own edge, and if you want to use mine, that's fine. That's why we've got the videos. But you have to know how you're going to execute in relation to it. And that's one of the biggest things. So you can see everything that I have on my trading chart, the executions, the interactions based on tempo, how the PA, the pure price action is moving, is going to be something you have to focus on to become more familiar with. Focus on risk management. You have to focus on not averaging down, on not impulsively jumping into trades. It's back to trading your edge exclusively. And no focus on other people's opinions. So eliminating social media, eliminating what should happen from your thought process, and going straight to what's the chart structure, where's the volume, what's the PA, not so-and-so thinks it's short, so-and-so thinks it's long. It gets really, really confusing. So what I don't want to do is have a bunch of people just following what I trade. What I want to do is have a bunch of people who trade their accounts based on what they've learned from an integrated environment and are together as a community, which is the purpose of the mastermind, so that we're all stronger together. And the way you're going to do that is to journal every single trade every day. And I'm just going to say it, no bullshit, no excuses. If you're not doing it, if you're not journaling, if you're not going to commit to a 30-day time frame to see what it changes, you're unlikely to be around this time next year. And I'm not saying that to be mean. I'm just saying if you want to be here, it's time to buckle down. It's time to focus on key structure, on risk management, and trading your edge, not just jumping in and out and back and forth. If you can't explain why you got in and out, you should not be in the trade to begin with. You need to know where your exit is as you're entering. So when is it invalidated? And so that's where I'm going to go ahead and put that journal together. Okay, I am horrifically behind in my appointment. So I will catch you guys on voice here in just a little bit.